Good morning again. You guys are ready for a review? All right. So let me once again make sense of the overnight auction. What happened overnight? We had a shock overseas, right? So the market sold down and eventually was able to discount the events, right? And amazingly, we see this recovery this morning before the open that exceeded yesterday's close. Now, notice what happened overnight. We sold down. We auctioned in this area. And by the way, we left a little bit of an excess pattern on the bottom here, that small single print tail, just 2 characters. I wouldn't make too much of it. Not unlike here where you have 5 or 6, or here where you have 20 or 30. But nevertheless, it is excess to the downside. Now, buyers and sellers auctioned this area, and once the overnight events were absorbed, because remember, the Globex session is a shock absorber. Okay? They auctioned this area, and eventually sellers exhausted. There was an exhaustion of sellers. Those who were short began to cover their positions, causing this move back up towards what? Yesterday's high volume area. And I suspect we're going to enter this area and top today somewhere in the middle of this range, 38.74, something like that. Understood? Okay, so how far will the bounce go? Since we're already trading in the pre-open above yesterday's close, the possibility of rising back towards the top trend line, the upper trend line of this falling wedge, is back on the table. Okay? 61.8% of yesterday's decline coincides with this area right here. All right. Like that. So we're probably going to test this area, flirt with it, this swing high, the 61.8%, and this contested line, this line in the sand that separated bull and bear territory over the last couple of days. Remember, we had initially this head and shoulders. The bulls responded, broke above it, came back, tested it, made a new marginal high. Yesterday, actually, it was just shy of a new high, even though on the QQQ we did make a marginal new high. And then we sold off into the end of the day. By then, it was pretty apparent that the falling wedge assumption was true. So now we're trading above yesterday's close, and it is very likely that we will reach the 38.70s. So here, right about here, it's 38.74. Let's, call it the 38.75 area. There are a couple of point difference between the basis between the NASDAQ cash and the September contract is, I don't know, 2-3 points. So let's not worry about a point or two. Just let's go back to the auction and realize that this magnet right here is in the 3870s, and that's where we're going. We're going to probably test the VPOC at 3874, 3875, whatever. Okay, and then once we reach this area, we will reestablish some short positions. We already have a runner. Remember, we left a runner yesterday. We didn't close out all our shorts in the QQQ because you never know what happens overnight. And you know, and the worst did happen, yet it wasn't sustainable. It wasn't sustainable. So there is a rhythm to the market, and you have to respect that. And we did respect it by booking profits along the way. Now, we are going to let it rise back and recoil before coming down to do what? To retest this area, because it won't be left untested. Not only retest it, but probably break below it. Look how low we reached last night. 38.2650 on the NQ. Understood? That's the plan for the day. Now, there is really not much to add. Why don't we take a look at some of the relative strength ratios again that we looked at yesterday but didn't quite get the opportunity to include in the recording. Before we look at the relative strength ratios, let's look at the few other indices. One of the most important ones to me is, of course, the SOX index. This guy continued on lower yesterday, and I said that it is destined to reach what? Into the target zone of wave 5 that I specified all along. Let's look at it right here. Now notice yesterday it almost made, it actually did make marginal new intraday high before ending up the day with a bearish engulfing candle. Wave 5's ideal target would be here, right below the gap fill. Let's say that it will fill the gap, reach 588. Now, can wave 5 extend even further down? Sure, it can. It can be a little more extended. It might threaten TDST support. Again, TDST support is what? You guys remember? It is the low of bar number 1 of TD cell setup. In this case, it's the low of bar number 2 because within the 9-bar series, it's bar number 2 that made the lowest true low. All right, so the SOX is confirming the weakness. When I start seeing the SOX rising, right, while the market is falling, maybe I'll call that a bullish divergence, and then I'll start looking for a turnaround in the market. Now the Dow Jones Industrial Average. Yesterday I brought to your attention the fact that this long-term trend line, which was taken out last December, is now posing as support. It's the line that you would draw across the 2000 high, January 1st, 2000 high, or that month, January 2000 high, since I'm looking at the monthly chart. So the high of January 2000 and the high of October 2007. You draw a line across it, and you see that price is sitting right on top of it. Now, if we do see a breach in the next few days I suspect this breach won't be sustainable. It will be repelled and price will be thrown back above, north of this line. It will be rebuffed, rejected, and it will be thrown north of that boundary. Call this bull territory, and this is bear territory. Okay, so once we see a price dip down, we see the S&P, for example, reach our target, and the NASDAQ 100 reach our target, and then later on, a couple of days later, we see the Dow north of this line. We know that indeed our downside targets have been reached. Now, I haven't been analyzing the Dow Jones, on a wave basis or chart pattern basis, but I've been keeping track of this particular chart. Now, the most beautiful thing about this is those two perfectly parallel trend lines that form the parallel trend channel, the green lines. Okay, every time we approach the top of the channel, we have a little bit of a shakeout. Look at that. Eventually, we're going to come up and hit it. Now, the reason why we sold off, or one of the reasons, is because there were signs of exhaustion. If you look back at May's candle, May 2014, we had a 9. TD sell setup 9. That was exhaustion. So this is one reason behind this shakeout. But if you look at the red numbers, in June we had TD combo bar number 11. We're still owed 2 bars before reaching 13. Now, these bars are not consecutive bars. Okay, there are rules for what counts as a red candle and what doesn't, and I will cover that in a video which I hope to record, if not this weekend, the next weekend. And then there's also the monthly TD sequential count. The last bar recorded was also in June. That was bar number 7. So according to the combo count, we need 2 more bars, non-consecutive, to reach 13. According to sequential, we need as many as 6 more to reach 13. So eventually, this agrees with my overall thesis that once this correction is over, we're going to have a few weeks to a few months of upside before a major correction gets underway. And I suspect when this happens, by then, the Dow Jones will have reached and touched the upper trend line of this green channel. All right? What next? Same thing with the Russell 2000, a beautiful pattern, connect the highs of 2000 and 2007, and you get a bullish breakout with a lot more upside if the blue arrow is any indication. Okay? Ultimately, the target is up here. Now, notice that on 2 occasions we came down and tested the 2000-2007 trend line, most recently in mid-May, and maybe we're doing the same thing right here. Now, because this line is upsloping, if we eventually come down and touch it one more time, we'll still be above the mid-May low, and that's what I'm expecting, an 88.6% retracement of the rally that unfolded from mid-May to early July. All right. Here again, DeMark tells us that we are on bar number 9 on TD sequential and 11 on TD combo. So there's more room to run before we fully exhaust. In other words, we reach maximum exhaustion. And believe me, overbought and oversold are a myth. As long as there's demand for stocks and for risk, overbought can get more overbought, and indicators are mostly useless. The market is all about supply and demand. As long as demand can absorb all the supply and then some, the market will keep rising. Now, when you look at this whole thing here, it looks like a sideways consolidation, a bullish pennant or something, or maybe a rectangle. And if we break out, remember, I called this a double bottom. The double bottom target is up here. All right, now let's look at some relative strength ratios. Let's go ahead and look at the performance of utilities versus the S&P 500. This would be the ratio of XLU divided by SPY, okay? XLU to SPY ratio. And I've noted all along that every time we see a crossover, the 15 EMA crossing over the 50 MA, we get a trend change. Now, this doesn't always happen. We had a crossover here. You have to wait for the crossover and then wait for the slope of the 50 period moving average to transition from red to green, meaning it becomes upsloping. The 50 MA begins to rise instead of fall. And so we had 3 months of outperformance on the part of XLU in early 2013. And remember, there was this guy, I'm not going to name him, who swears by utilities on Twitter and was calling for a crash or a major correction in 2013. Yet, in my recent videos, I made it clear why 2013 was the year of the third wave. Remember? The year of the third wave. So to base your analysis on a single variable is an ill-advised thing. You cannot base your technical analysis on one variable, in this case XLU. Anyways, here we had a crossover. The 50 MA transitioned from up to down, was rising here, now it started falling, and this confirmed what? It confirmed a new downtrend, and that downtrend would last into almost end of the year. And then we got this crossover at the start of the year, a brief period of outperformance on the part of XLU, and that outperformance ended when we spotted what? A head and shoulders in this relative strength ratio. When the XLU over SPY traced out a head and shoulders, it signaled the start of a new downtrend. When did this happen? Late April. When did this head and shoulders confirm? Mid-May. Exactly when the indices bottomed. Isn't that a beautiful tool to time the market? And now, what happened? We fell below. We had the cross under. 15 EMA crossed under the 50 MA. Price crossed under, broke below the channel. And then there was a mean reversion period where the 50 MA was still flat. So the ratio got sucked back towards it, and then boom, by the time the 50 MA began to fall down, the XLU crashed relative to SPY. This is what I call a rubber band setup. When price moves above a falling 50 MA for the first time, meaning once the 50 MA transitions from one direction to another, and then price immediately crosses over it, this is a rubber band setup, and this is where we are now. Yesterday we had outperformance on the part of XLU, but it's just one day. During a trend, an uptrend, you're going to have up and down days, but in a downtrend, you're going to have more down days than up days. Okay, so what's happening here? Mean reversion to the 15 EMA, maybe a little higher by the time it's all said and done. Okay, next, the SOX index relative to the S&P 500. I've done a video on that. I'm not going to repeat what all this is. You may want to watch the video on YouTube. But look here, once again, the trend of the SOX relative to the S&P 500 is up. Okay, look at that. Beautiful inverse head and shoulders, crossover, 50 MA transitioned from red to green, and I do use the 50 MA as my trend indicator. Okay, the trend is still up. However, we reached exhaustion a few weeks ago. We got a TD sequential sell 13 and a TD sell setup, bar number 9. What's happening here? Having broken above this channel, okay, having broken above this channel, we're probably coming down to touch it or even touch the 50 MA. Okay, this is a mean reversion move. Now, we do have reason to believe that the SOX has made a sustainable high. The recent high in the SOX will probably stand for several months because the current pattern is a 5-wave move down, meaning the SOX will probably make a lower high in the coming months while the indices like the S&P and NASDAQ make new all-time highs. Therefore, we are on the lookout for a potential bearish divergence between the SOX on one hand and the indices on the other. The other thing that I like that tells me that maybe there's light at the end of the tunnel and this correction is about to be over is the performance of small cap stocks relative to large cap stocks. And I'm talking about S&P small cap stocks, the S&P small caps index relative to the S&P large cap index. Well, small caps have been taken to the woodshed as of late. You know all about that. However, the performance of small caps relative to the S&P 500 have begun to rise. The relative strength ratio, meaning the small caps have begun to outperform the S&P 500 as indicated by those last few, 5, 6, 7 candles. It's been on the rise despite all that weakness in the market. The small caps have been outperforming, either falling at a slower rate. When the market is falling, small caps are falling at a smaller rate relative to the S&P. And then when the market is rallying, they're rallying faster, at a faster rate than the S&P. So maybe, just maybe, what we're seeing here is similar to what we saw here. Now this base here, even though we got the crossover, this was not sustainable. Okay, we got the cross under before the 50 MA had the chance to turn green. We ran into the 100 period moving average. That was the high. We ran into it. What's the difference between here and here? Here, the 100 MA and the 200 MA are rising. Here, they were falling. So we're going to keep an eye on it and see if we're going to run into the red line or the 100 MA once again, or whether these things are going to change slope and begin to rise, giving the small caps room to run for the next few months. We'll keep an eye on that. Respect these three moving averages, the 50, the 100, and the 200. I use them on all time frames for support and resistance. The 100 and 200, I use them for support and resistance. The 50, I use for not just support and resistance, but I use it as a trend indicator. It's the trader's best friend. The direction of the 50 MA is the trader's best friend. And I also use the 15 EMA for the short-term trend. Whenever I see a crossover, it means there is acceleration in momentum. Now, that I use this among other things, of course. What next? QQQ relative to SPY. QQQ versus SPY relative strength ratio. So basically what I'm doing is I'm plotting on this chart the ratio of QQQ to SPY. And I love this because back in May, I called for this crossover. The QQQ began to outperform the SPY once again, and the 50 MA turned up, began to rise. This indicated the start of an outperformance period on the part of QQQ versus SPY. And that's exactly what we're seeing right here. Now, not only did we come back to the prior highs, but we've exceeded them. And the ratio continues to rise, portending appetite for risk. Under the hood, smart money is accumulating. Okay? The market in general is what? Is a magician. It uses misdirection to divert your attention away from what's really happening. What's really happening is that the QQQ is outperforming SPY, meaning appetite for risk is alive and well. Now, we don't have anything resembling the situation back in early March. In early March, we had a cross under. Okay, we topped here, began to fall, got the cross under, and then there was this red trend line that you see. It broke, it got broken, meaning price, the ratio broke below it on March 7th. And if you look at some of the momentum stocks that you follow, like Google and whatever, all these stocks topped on May 7th, including the NASDAQ, by the way, around May 7th. And then we had that 2 months of weakness from early March to mid-May. See how strong and powerful this relative strength ratio is, and how much of a forward-looking indicator it happens to be. Okay? Now, let's look at the NASDAQ Banking Index. Bank. I was told a while ago that keep your eye on bank. If bank is falling and the market is rallying, then the rally is unwarranted. The banking index must rise with the market to confirm the rally. Here it's still falling. Sure, we had a good day 2 days ago, but yesterday was a dark cloud cover. I think we're going to stabilize near the prior PRZ. Remember that bullish bat? We've exceeded it slightly to the downside and rallied. So we're going to retest this area and turn back up. Here we have an exhaustion signal, TD combo buy 13. Look how large this bar is. That large bar portends volatility. If you take the size of this bar and double it down, this is where, somewhere down here where the PRZ is the line below which this exhaustion signal will be invalidated. I think we are on bar number, yesterday was actually bar number 9 of TD buy setup. So I think we are very close to reversing course to the upside. Notice also the momentum indicator, where I've counted as many as 7 waves correlated to cycle highs and lows on the stochastic. Normally, look at here, 7 waves down, and then we started with wave 1 and wave 2 on momentum. However, we had what? A lower low on price. Here's the low on price. Here's a lower low on price. Here's the low on momentum, wave 7, a higher low on momentum. This created what? A bullish divergence, because momentum to the downside wasn't as strong when we made a lower low. This automatically qualifies as a potential bullish divergence, and sure enough, we rallied from mid-May to early July. We're looking for something very similar to happen in the coming days. Next, let's look at the performance of corporate bonds relative to safe treasuries. This is the ratio of JNK to TLT. I've pointed out this head and shoulders. How far back? Months ago. And I drew this black channel. Sure enough, in late May, a couple of weeks after the indices turned up, junk bonds began to outperform treasuries again. Okay, made a new high, broke above the neckline, the support line, but mysteriously in early July they began falling again, and they crossed back under the neckline. That was a canary in the coal mine. We should have heeded this warning, knowing that even though the indices are rising, the underpinnings of the market are weak. Okay, the indices are on precarious ground, and that's exactly what happened. Kept falling, and suddenly it took how long for the indices to turn down, or to top and reverse course? We know the SOX stopped around July 16th. The indices like the NASDAQ and the S&P, I think it was around July 24th. So look at this. This guy here told us, be careful. And he said to us, be careful as early as July 8th when it crossed under this line. Of course, Not everything happens at once. The indices kept rising and rising because there was a chart pattern target to be reached. There was a top of the channel on the NASDAQ to be reached. Okay? And then when the string is stretched to the maximum, that's when it snaps, it breaks, and the stuff hits the fan. Now we're back below the channel. You can still see that TLT is outperforming junk bonds, corporate bonds, and until we see a genuine reversal to the upside, we're going to keep our eyes open and our warning flags up. All right, I'm going to wrap up the review. That's all I got this morning. Sure enough, look at this. The NQ has penetrated the high volume area of yesterday's regular trading hours session, and that's exactly what we're looking for. However, demand is thinning out, meaning we are starting to see signs of buyer exhaustion. Okay? A lot of short covering has already taken place. When the regular trading session opens, we might come back up here briefly and then begin to fall down slowly and methodically. I don't know if we're going to reach down here by the end of the day, or this will be something for next week. All right, but it is worth keeping an eye on. We want to increase our short position right up here and sit back, relax, and watch this whole thing do what it's supposed to do. All right, we'll see you at the open.